You wake up every morning, check your bank account, and wonder where your money went. Your paycheck looks the same as it did 5 years ago, but somehow everything costs more. Your rent, your groceries, your car payment, even your morning coffee. Politicians blame inflation. Economists point to supply chains. The media talks about global uncertainty. But what if I told you that's not the real reason you're getting poorer? What if the explanation everyone's giving you is covering up something much bigger, much more systematic, and much more devastating to your financial future? There's a pattern playing out in America right now that has nothing to do with rising prices and everything to do with where your money is actually going. While you've been told to tighten your belt and wait for inflation to cool down, $50 trillion has been systematically transferred from working families to the wealthiest Americans over the past 4 decades. That's not a typo. $50 trillion. That's $297,000 per household that should have stayed in your pocket, but ended up somewhere else entirely. This isn't about partisan politics or economic theory. This is about mathematical reality. The numbers don't lie, and once you see what's really happening, you'll understand why your dollar doesn't stretch like it used to. Why your parents could buy a house on 1 income while you can barely afford rent on 2. Why productivity keeps rising, but your paycheck stays flat. The system has been redesigned and you weren't invited to the meeting. Let me show you exactly how this wealth transfer works, who's benefiting from it, and why blaming inflation is missing the point entirely. Because understanding the real problem is the first step toward protecting yourself from it. Here's what most people don't realize about American wages. Despite all the talk about economic growth, job creation, and record stock market highs, the average worker today has the same purchasing power they had in 1980. Not less purchasing power, not more purchasing power, exactly the same. Your paycheck buys the same amount of goods and services that it did 43 years ago. Think about that for a moment. 4 decades of technological advancement, productivity gains, and economic expansion, and the typical American worker has made zero progress. But here's where it gets interesting. The economy didn't stay flat during those 43 years. It grew massively. American workers became dramatically more productive. Companies generated record profits. The stock market soared. Wealth was created at unprecedented levels. So if all this value was being generated, where did it go? The answer reveals the most significant economic shift in modern American history. Between 1980 and 2022, workers in the bottom 90% of earners saw their wages grow by just 36%. Meanwhile, the richest 1% saw wage growth of 162%. The top 0.1%, the truly wealthy, saw their incomes grow by 301%. This isn't about some people working harder or being smarter. This is about a fundamental restructuring of how economic gains are distributed in America. To understand how dramatic this shift has been, consider this comparison. In 1963, the wealthiest families had 36 times the wealth of families in the middle of the wealth distribution. By 2022, they had 71 times the wealth of middle-class families. The gap didn't just widen, it exploded. Today, the richest 10% of American households own over 2/3 of the nation's total wealth. The bottom 50% of earners own just 2.5% of total wealth. This level of concentration hasn't been seen since the Gilded Age. Now, you might be thinking this is just the natural result of a market economy. Some people win, some people lose, and that's how capitalism works. But what if I told you this concentration of wealth wasn't the result of market forces alone? What if it was engineered through specific policy changes and corporate practices that were deliberately designed to transfer money from workers to owners? Let me show you the mechanism that makes this possible. It's called the productivity pay gap, and it's the smoking gun that proves American workers are being systematically shortchanged. For most of the 20th century, as workers became more productive, their wages rose proportionally. When companies made more money per hour of labor, workers shared in those gains through higher pay. This relationship held steady from the 1940s through the 1970s. Productivity and wages moved together like dance partners. Then something changed. Starting in the late 1970s, productivity and wages began to diverge. Workers kept getting more productive, generating more value per hour of work, but their paychecks stopped keeping pace. Since 1979, worker productivity has increased by over 70%, but wages for typical workers have grown by just 12%. This means that for the past 4 decades, American workers have been generating massive amounts of additional value that they're not being compensated for. Think about what this means in practical terms. If you work the same job your father worked, you're producing 70% more value per hour than he did, but you're not getting paid 70% more. You're getting paid roughly the same, adjusted for inflation. The extra value you're creating is going somewhere else. It's flowing upward to executives, shareholders, and owners, while you're told to be grateful for cost of living adjustments that barely keep pace with rising prices. This productivity pay gap represents the largest transfer of wealth from workers to owners in American history. We're not talking about small amounts of money. We're talking about trillions of dollars that were generated by worker productivity, but captured by capital owners instead of being shared with the people who created that value. But how exactly does this transfer happen? It's not like companies are directly taking money out of your paycheck and handing it to their shareholders. The mechanism is more sophisticated than that, and it involves practices that most people have never heard of, but that fundamentally reshape how corporate profits are distributed. The first mechanism is stock buybacks. Before 1982, stock buybacks were considered market manipulation and were essentially illegal. Companies could repurchase their own shares only in limited circumstances, but rule changes in the 1980s opened the floodgates for what would become the largest redistribution of corporate resources in history. Between 2003 and 2012, the 449 firms in the S&P 500 used 54% of their earnings to buy back their own stock. That's $2.4 trillion that could have gone toward worker wages, research and development, or productive investments. Instead, it was used to artificially inflate stock prices, add in dividends, and these companies dedicated 91% of their earnings to enriching shareholders rather than investing in their businesses or workers. Why do companies prioritize stock buybacks over everything else? Because executive compensation is now tied primarily to stock performance. Today's corporate executives receive the majority of their pay through stock awards and stock options, often more than 80% of their total compensation. When they use company profits to buy back shares, they drive up the stock price, which directly increases their personal wealth. It's a system designed to incentive executives to transfer money from productive uses to financial engineering that benefits them personally. During the first full year after the 2017 Tax Cuts and Jobs Act, S&P 500 companies spent $806 billion on stock buybacks. Even during the pandemic, when millions of Americans lost their jobs and businesses struggled to survive, companies bought back $521 billion worth of stock, rather than using those resources to support their workers and communities. This isn't just about big corporations making big profits. This is about a systematic redirection of economic value away from the people who create it toward the people who own financial assets. Every dollar spent on stock buybacks is a dollar that didn't go toward higher wages, better benefits, job training, or business expansion that could create more opportunities for workers. The second mechanism involves market concentration and corporate power. Since the 1980s, American industries have become increasingly dominated by a small number of large companies. This concentration gives these firms enormous leverage over both workers and consumers, allowing them to suppress wages while raising prices. In 91 of the 157 primary industries tracked by financial data companies, the 5 largest firms combine for at least 80% of total revenue. This level of market concentration hasn't been seen since the early 1900s, before antitrust laws were established to prevent monopolistic practices. When companies face limited competition, they can keep wages low because workers have fewer alternatives. They can also charge higher prices because consumers have fewer choices. This combination of suppressed wages and elevated prices squeezes workers from both directions, reducing their purchasing power even when inflation appears moderate. The evidence for this squeeze is overwhelming. Corporate markups, the difference between what it costs to produce something and what companies charge for it, have tripled since 1980. Companies are charging 61% more than their marginal costs today, compared to 21% in 1980. These elevated markups represent pure profit extraction that comes directly out of consumers' pockets. Meanwhile, corporate profits as a share of the economy have reached levels not seen since the 1920s. Companies are generating record profits not through innovation or efficiency improvements, but through their ability to charge more while paying less. This is the definition of market power, and it's being exercised at the expense of ordinary Americans. But here's what makes this situation particularly insidious. While your wages stagnate and prices rise, you're being told the problem is inflation. You're being told that rising costs are the result of external factors beyond anyone's control: supply chain disruptions, government spending, global uncertainty. All of these factors play a role in price increases, but they mask the deeper structural changes that are systematically transferring wealth from workers to owners. The inflation narrative serves a crucial purpose for those benefiting from this wealth transfer. It shifts attention away from corporate practices and policy choices and towards seemingly natural economic forces. Instead of asking why wages aren't keeping pace with productivity, you're encouraged to focus on why prices are rising. Instead of questioning why corporate profits are at record highs while worker compensation lags, you're told to wait for inflationary pressures to subside. This redirection is incredibly effective because inflation is visible and immediate. You feel it every time you go to the grocery store or fill up your gas tank. The wealth transfer, on the other hand, is largely invisible. You don't see the stock buybacks happening. You don't see the productivity gains you're generating. You don't see the corporate markups being applied to the products you buy. You just see that your money doesn't go as far as it used to, and you're told that's because of inflation. But the real story is more complex and more troubling than simple price increases. What you're experiencing isn't just inflation eating away at your purchasing power. You're living through the consequences of a decades-long restructuring of the American economy that has systematically redirected the fruits of your labor away from your paycheck and into the investment portfolios of the wealthy. Let me show you how this plays out in your daily life. When you produce value at work, That value gets measured and tracked by your company. They know exactly how much revenue you generate per hour, how much profit your work creates, how efficiently you perform compared to previous years. This data drives business decisions about pricing, expansion, and resource allocation. But here's what doesn't happen. That increased value you're creating doesn't automatically flow back to you in the form of higher wages. Instead, it gets captured by what economists call rent extraction. This is when companies use their market position to claim a larger share of the value created by their workers without providing any additional benefit in return. It's not theft in the legal sense, but it's a systematic redirection of economic value that would have historically been shared between workers and owners. Consider what happens when you become more productive at your job. Maybe new software makes you twice as efficient. Maybe improved processes let you handle more customers per hour. Maybe better tools allow you to complete tasks faster. In a properly functioning labor market, this increased productivity should translate into higher wages. Companies can afford to pay you more because you're generating more value. But in today's economy, that additional value gets siphoned off through financial engineering before it reaches your paycheck. The company takes the extra profit from your increased productivity and uses it to buy back stock, which inflates share prices and triggers executive bonuses tied to stock performance. Or they use it to pay larger dividends to shareholders, or they invest it in automation technology designed to eventually replace workers entirely. The one thing they don't do is share those productivity gains with the people who created them. This dynamic explains why you can work harder, smarter, and more efficiently than your parents ever did while still struggling financially in ways they never experienced. It's not because you're doing something wrong, it's because the system has been redesigned to capture the value of your increased productivity before it can improve your living standards. The housing market provides a perfect example of how this wealth extraction operates on a massive scale. Over the past decade, private equity firms and institutional investors have purchased hundreds of thousands of single-family homes, often paying cash and bidding above asking price to outcompete individual buyers. They then convert these homes into rental properties, extracting monthly rent from people who would have previously been able to buy. This isn't about providing a valuable service. These investors aren't creating new housing or improving existing properties. They're inserting themselves as middlemen in the housing market, capturing wealth that would have previously built equity for working families every month. Instead of building ownership through mortgage payments, renters send money to investment funds that use those rental payments to buy more properties, further restricting home ownership opportunities. The result is a self-reinforcing cycle. As more homes get converted to rentals, fewer homes remain available for purchase. This drives up prices for the remaining homes, making home ownership even more difficult for ordinary workers. Meanwhile, rental demand increases, allowing property owners to raise rents and extract more wealth from people who have no choice but to pay. This same pattern repeats across multiple sectors of the economy. Private equity firms buy up medical practices and optimize them for profit extraction rather than patient care. They acquire nursing homes and cut staff to boost returns. They purchase retail chains and load them with debt while paying themselves massive dividends. In each case, they're not creating new value. They're capturing existing value and redirecting it away from workers, customers, and communities toward financial investors. The pharmaceutical industry demonstrates another dimension of this wealth extraction system. Companies routinely take drugs that were developed using government-funded research, patent them, and then charge prices that bear no relationship to development costs or manufacturing expenses. A medication that costs $5 to produce might sell for $500, not because of market forces, but because patent protections eliminate competition. These pharmaceutical companies then use their monopoly profits to fund stock buybacks and executive compensation, rather than investing in new drug development. They're extracting wealth from sick people who have no choice but to pay whatever price is demanded for life-saving treatments. This isn't innovation being rewarded by market success. This is rent extraction, enabled by government-granted monopolies. The credit industry operates on similar principles. Banks and credit card companies have engineered fee structures that systematically transfer wealth from people who need financial services to shareholders who own financial assets. Overdraft fees, late payment penalties, and interest rate structures are designed to maximize revenue extraction from customers who have limited alternatives. When you get hit with a $35 overdraft fee for a transaction that caused a $2 shortage in your account, you're not paying for a service that costs $35 to provide. You're paying a penalty that's calculated to generate maximum profit while being just small enough that most people won't switch banks. The fee structure is designed around behavioral psychology rather than actual costs, optimized to extract wealth from customers who make predictable financial mistakes. These practices collectively represent a fundamental shift in how the American economy operates. Instead of companies competing to provide better products and services at lower prices, they compete to find new ways to extract wealth from captive customers and workers. Instead of innovation driving profits, financial engineering drives profits. Instead of productivity gains being shared broadly, they're captured by a narrow group of asset owners. The tax system has been restructured to accelerate this wealth concentration. Capital gains, the profits from selling investments, are taxed at lower rates than wages from working. This means that people who make money from owning assets pay lower tax rates than people who make money from labor. It's a direct incentive to shift economic activity away from productive work toward financial speculation. Corporate tax rates have fallen dramatically since the 1980s, allowing companies to keep more of their profits while shifting tax burdens to individual workers. Estate taxes that once prevented the concentration of inherited wealth across generations have been weakened or eliminated. The result is a tax code that actively encourages wealth concentration while discouraging productive work. Meanwhile, the regulations that once limited financial speculation and protected workers from exploitation have been systematically dismantled. Banking regulations that prevented excessive risk-taking were repealed, leading to the 2008 financial crisis. Labor protections that gave workers bargaining power have been weakened, reducing their ability to claim a fair share of the value they create. Antitrust enforcement that once broke up monopolistic companies has been abandoned, allowing unprecedented market concentration. This isn't accidental. These changes were the result of deliberate policy choices made over decades, often justified with economic theories that claimed deregulation and tax cuts would benefit everyone through increased economic growth. But the promised benefits never materialized for ordinary workers. Instead, these policies created exactly what economic theory predicted they would create: a massive transfer of wealth from workers to owners. The financial sector exemplifies how the system operates at scale. Banks that once served primarily as intermediaries connecting savers with borrowers have transformed into profit extraction machines that generate revenue through complex financial products designed to transfer risk to customers while guaranteeing returns to shareholders. High-frequency trading systems extract tiny profits from millions of transactions, adding no productive value while siphoning wealth from pension funds and individual investors. Derivative markets create artificial scarcity and volatility that generates trading profits while destabilizing the underlying economy. Credit default swaps and other synthetic financial instruments allow speculation on economic failure, creating incentives for financial institutions to profit from economic distress rather than economic success. This financialization of the economy means that an increasing share of corporate profits comes from financial manipulation rather than productive activity. Companies spend more time and resources on financial engineering than on research, development, or worker training. The result is an economy that's optimized for wealth extraction rather than wealth creation. So the next time you hear someone blame inflation for your financial struggles, remember what's really happening. Your money isn't disappearing because prices are rising faster than usual. It's disappearing because a 40-year wealth extraction system has been engineered to capture the value you create before it reaches your paycheck. Understanding this isn't just about economics. It's about recognizing that your financial future depends on seeing through the narratives designed to keep you focused on symptoms rather than causes. The system can be changed, but only if enough people understand how it actually works.